Hello everyone. Let's get to understand few of the concepts of accounting on which the accounting process is based upon. However, before getting into the details of accounting concepts, we must understand what is accounting. So, accounting is actually an art, unlike your physics or mathematics or chemistry, whereby they are governed by certain thumb rules. But in accounting, it is basically an art which are based on few of the generally accepted assumptions or the principles. The accepted assumptions basically becomes the rule of the game, and based on these premises of these assumptions the concepts have been derived, and based on those concepts the entire accounting process is governed. So now getting into the few of the details of these concepts. First, the first concept of this one would be money measurement concept. Now, what does this money measurement concept say? So money measurement concept is nothing but it says that anything that you cannot measure on a unit basis of money cannot be counted as an accounting transaction. What it means is money has been accepted by the accounting system as its basic unit of measurement in as much as it is the monetary expression of the economic event. That means this concept requires that those transactions alone which are capable of being measured in terms of money are to be recorded in the books of accounts. If you cannot measure any of the event in terms of money, then that cannot be treated as an accounting transaction. But the problem arises with this concept is this concept assumes that the purchasing power of money remains constant throughout the period. So that way, it always takes that same unit of measurement for the previous period, past period, current period, and the future period. The other aspect of this concept is many important things like, for example, the loyalty of the workforce of any organization cannot be measured in terms of money, but that becomes one of the major players of any progress of any organization. Now, the second basic concept of this accounting assumptions are dual aspect. Now, what does this dual aspect mean? What this assumes is at any point of time, the total assets of the organization should always be equal to the total liabilities of the same organization. Okay, so what it says is whatever transactions that we do for that particular event, that will always involve two sides. One will be your assets or will be an liability. If not, it will have two aspects, either only one side or on the both sides. To be very precise, it can involve two aspects of assets or two aspects of liabilities, or it can involve one aspect of asset and one aspect of liability. But at any point of time for any transaction, there must be two legs to complete a transaction. Now, when we are saying liability, so liability can also be divided into two further segments. One is called as capital, the other one is called as liabilities. So what is capital and what is liabilities? Capital is nothing but the liabilities that are being owned or for the owners, and what the liabilities that are for the outsiders are called as the total liabilities. So from a company or an organization point of view, organization owns that capital, owes that capital to the owner of that organization. That's why we treat that as an liability. So in principle, your total assets becomes your capital plus liability, or total assets equal to total liabilities. Okay, just to brief few of the examples, like how the legs of any transaction involving these assets and liabilities can create or reduce the assets and liabilities. I'll just cite few of the examples or the scenarios. See, first one would be like in a scenario where there will be an increase in the asset as well as an increase in the capital. Okay, just for an example, the owner introduces capital into the business. So what happens with that is your cash increases, at the same time the liability for the capital increases from the company side, right? So that way your total assets have increased as well as your liability. Another example would be increase in your asset and increase in your liability. Okay, for example, if you have to buy a plant on credit, so what does it do? So you get your asset, right? Plant is an asset for you, so you get your asset, but at the same time, because you have bought it on liability, you also increase your loan, which becomes your liability. So your total assets equal to your total liability at that point as well. To cite another example, increase in asset and decrease in another asset. That would be like scenarios where you have purchased your machine, in continuation to the previous example, you have purchased in your machine, but not with loan, but with cash. So this involves only total assets, whereby one of your asset has reduced and the other asset has increased. The other example that I would like to share here is decrease in liability and increase in another liability. Like creditors paid off by arranging loan. You would have taken a loan to pay off your creditors. So that means you have decreased one liability, but you have increased another liability. So that way, so this tells us saying that you at any point of time there will be like two legs. Either it can involve only assets or only liabilities, or it can also have assets as well as liabilities. But it's a very important concept to get into the advanced level of accounting standards or accounting principles. Now, the third concept that I would like to share here is the going concern concept. So what this means is, when you start a company or an organization from an accounting standard point of view, what does this assume is the entity that we have commenced is forever. Okay, so that means it says that there is no end point to that organization. It always believes this will continue forever. It's for an infinity. That's the concept that this assumption believes, that the concern we have is it's a going concern entity. Okay, unless the venture itself is terminable. Okay. The next concept is periodicity. Now, what does this concept say us? So when we are saying periodicity, it says that when we have a going concern concept, it's something very much related to your previous concept of going concern. So whereby in the previous concept that we said that the entity will be forever, but in the periodicity concept, what it says is, if you are assuming the business is going to be forever, then how do you compare your performance? How do you know, like, where do you lie, what you thought and where you have landed? So for that, the new concept has been introduced, is that is the periodicity. What does it? It says to measure your performance, you must have your period or your going concern period to be fragmented into equal periods, so that you can measure your performance for your previous period against your current period, or at the same time you can also assume what you are going to be landed in the position on your future periods as well. So basically it says the timeline should be divided into equal periods. Now the next concept is accrual concept. Okay. So this is basically a consequence of your previous concept of periodicity. So what it says is, this is a system. Okay, basically this accrual is a system that recognizes revenue and expenses as they are earned or incurred. Okay, so and they don't consider the date and time of the receipt or payment. Okay, what it basically says is the expense and revenue, if you're earning or incurring for any particular period, then those must be incurred and recognized on that particular period. To cite an example, you have provided services to a client for this month, and but the client is, as per the agreement, the client said, okay, we have provided your services for this month, but I would be paying you only on next month for the services provided for this month. So with this concept, what will has to happen is, even though you're receiving your revenue for next month, but you must recognize that revenue only in this month, because the revenue is pertaining to the services provided for this month. Okay, similarly, for example, you have paid some vendor in advance, you have made some prepayments for any particular services from one of the vendors. So what happens, like, you have paid it for future period, where the vendor is liable to provide the services for the future period, but you have made the payment in advance. So you cannot incur the entire, you cannot recognize the full amount of prepayment that you have made to the vendor, because it's a prepayment for the previous it's a prepayment for the future services expected. So that's why we need to defer that expense that you have made for the future period, and recognize only the amount of prepaid services for this month. So that's what it says, the accrual concept. Now again, the other concept is the matching concept, which is again in line with the accrual concept. What it says that, the revenue and expense should go hand in hand. So if you are recognizing your revenue, then the corresponding expense must also be recognized on that same period. So it's very much similar to the accrual concept that we discussed previously, but again, the only difference is it says that revenue and expense should go in line. The last concept that I have here is the conservatism. So what it says is, recognize all your losses but do not anticipate any gains. Okay, so basically it says, to early recognition of any unforeseeable events. What it means is, if you are estimating something is likely to happen, some event is likely to happen, and you are likely to incur some losses of that on that event, then this concept says that to recognize that loss, but at the same time, on a similar event, you are estimating that probably there could be some revenue, or there could be some additional profit that we are likely to gain, then we must not create any provision for that additional revenue that we are estimating. But the other side, if you are expecting some losses, then you must create some provision for that loss in now itself, instead of waiting till the event happens. So these are few of the basic concepts on which our entire accounting process depends on. Thank you for watching. Thanks a lot.